The streets of New York City, 1,929. The air hums with euphoria. Automobiles gleam under the rising Sunday champagne flows. Everyone believes they found the secret to eternal prosperity. Between 1,921 and 1,929, the Dow Jones Industrial Average didn't just rise, it exploded. From 63 points to 381, a six-fold increase in 8 years. America had never seen wealth multiply so fast. Economist Irving Fisher proclaimed in September 1929 that stock prices have reached what looks like a permanently high plateau. He wasn't alone. Newspapers declared a new era of endless growth. But behind the optimism, a small group of bankers, the true architects of the money supply, were watching something else. A storm forming beneath the numbers. Here's the secret. The roaring stock boom wasn't built on real wealth. It was built on debt. Millions of ordinary Americans bought shares on margin, paying just 10% of the price, borrowing the rest. Their collateral? The very stocks they were buying. It was a financial Ouroboros money feeding on itself. And who supplied this easy money? Banks like National City Bank, led by Charles E. Mitchell, one of the most powerful men in finance. Mitchell's empire lent billions through brokers, fueling speculation and greed. Every dollar borrowed tightened Wall Street's link to the Federal Reserve, the central bank created in 1913 to stabilize the economy. But inside the marble halls of the Federal Reserve Board, not everyone agreed with what was happening. Many governors saw the frenzy as dangerous. They believed the Fed's resources were being hijacked not to build factories or fund trade, but to inflate paper profits. The Federal Reserve Act, they argued, was never meant for the creation or extension of speculative credit. Yet, speculation was exactly what America had become addicted to. And when a nation becomes addicted to debt, it needs someone to decide when to cut the supply. That decision would soon come. Not from the president, not from Congress, but from a handful of men meeting behind closed doors in New York and Washington. Men who understood that controlling credit means controlling everything from stock prices to governments themselves. And when they acted, the world changed forever. To understand why these men made their move, and how their decision ignited the greatest financial collapse in modern history, we need to go back in time to the very birth of the system they controlled. The Roaring Twenties were more than just a party. They were a carefully constructed illusion powered by credit, confidence, and control. Factories boomed, radios blared jazz across every city, cars rolled off assembly lines faster than ever before. The American dream had been industrialized and financed. Behind this explosion of wealth stood a new breed of banker. Not the old money aristocrats of Europe, but financial engineers who turned debt into gold. Charles E. Mitchell, head of National City Bank, now Citibank, was their symbol. He pioneered the modern financial product, the investment trust, the margin account, the dream of owning stocks with borrowed money. It was seductive, and it worked until it didn't. By 1928, ordinary clerks, mechanics, and housewives were buying stocks as if it were a guaranteed ticket to wealth. All they needed was 10% down. The rest came from call loans, short-term credit provided by banks to brokers, who in turn lent to investors. The total volume of these loans soared into the billions. It was a debt pyramid balancing on faith. But far from the cheering crowds, in Washington, the Federal Reserve Board was alarmed. They saw credit flowing away from factories and farms into speculation. They believed the system was violating the sacred real bills doctrine, the idea that money should only be issued to finance real economic activity, not paper gambling. The Fed wanted to stop the mania. But the problem was, the mania was profitable. In New York, George L. Harrison, the governor of the Federal Reserve Bank of New York, had a different view. He argued that the market wasn't overheated, it was efficient. He pushed for a cleaner method, raise the discount rate, the interest charged to commercial banks. If money became more expensive to borrow, speculation would naturally slow down. But in Washington, the board hesitated. They feared that tightening credit could break the system. After months of debate, they finally caved. In August 1929, the New York Fed's rate rose to 6%, the highest in its history. That single number 6 became the invisible spark. Because under the international gold standard, the Fed's decision forced other central banks in London, Paris, Berlin to raise their own rates. A chain reaction began. Credit dried up across the world. Trade slowed. Factories in Europe began to close. But on Wall Street, the lights still shone. The party roared on. Investors ignored the warning signs. Charles Mitchell assured the public that everything was fine. Even as cracks appeared in the system, the brokers kept lending, and the public kept buying. The stage was set. A nation hypnotized by rising numbers, led by bankers who thought they could control the tide. They couldn't. Because the moment one piece fell, the entire illusion would come crashing down. And it did one Monday morning in October 1929, when the illusion shattered in a single sound. The roar of panic. The day the market lost its mind. By the time the sun rose over Manhattan, the mood on Wall Street had turned from celebration to fear. Traders rushed through the doors of the New York Stock Exchange, their faces pale. Phones rang endlessly. Orders screamed through the air. The Dow Jones Industrial Average plummeted 12.8% in a single day, a drop the world had never seen before. That Monday would be called Black Monday. The next day, Black Tuesday, would be worse. Another 12% vanished. By mid-November, half of America's stock market was gone. Fortunes evaporated in hours. Lives collapsed in days. The cameras outside the exchange captured a sea of confusion. Men in hats staring blankly at the ticker tape, watching their dreams disintegrate. Women crying in silence. A nation in disbelief. But here's what most people didn't see. As the public panicked, a quiet battle unfolded behind closed doors. Charles E. Mitchell, the same banker who had fueled the bubble, tried to stop it. He organized a coalition of financiers, pooling millions to buy stocks at support prices. The move was supposed to restore confidence. But the crowd had lost faith. They sold even faster. Mitchell's lifeline snapped, swallowed by a tidal wave of fear. Yet the true danger wasn't the market itself. It was the credit system that supported it. When stocks crashed, the loans tied to those stocks collapsed too. Banks that had lent billions on margin suddenly held worthless collateral. The money supply began to freeze. Depositors rushed to withdraw their cash. The financial arteries of the nation clogged overnight. And in that chaos, one institution stood between survival and collapse. The Federal Reserve Bank of New York. Its governor, George Harrison, ordered emergency action. The Fed began buying government securities, lending freely, and even lowering its discount rate, the very tool it had raised months earlier. In effect, the same hand that had tightened the noose now tried to loosen it. For a brief moment, it worked. Commercial banks in New York stayed open. The system held together. But the damage was already spreading. Factories cut production. Ford Motors slowed its assembly lines. Unemployment began to rise. And the fear that unquantifiable contagion infected every household in America. People who once dreamed of prosperity now hid what little they had left. The streets that once symbolized the American dream now echoed with a single word: trust. It had vanished. Yet beneath all this chaos, the real story was not over. Because even as the economy burned, certain men and institutions emerged untouched, even stronger. The collapse, it seemed, had not destroyed the system. It had only revealed who truly controlled it. But how could a crash so devastating strengthen the very powers that caused it? The answer lies in the hidden mechanism, the invisible machine of credit and gold that ruled the 20th century from the shadows. The panic of 1929 was only the surface. Beneath the chaos, a far deeper system was at work, one that determined who suffered and who survived. That system was built on gold, credit, and control. And it was designed to protect one thing above all: the power of the banking elite. Let's unravel it. When the Federal Reserve raised its discount rate to 6% in August 1929, it wasn't just tightening credit in America. Under the international gold standard, that single decision sent shockwaves across the globe. Other central banks in London, Paris, Berlin were forced to raise their own rates to defend their gold reserves. It was a global chain reaction. The logic was simple, brutal, and invisible to most. When the Fed tightened money, gold flowed toward the U.S. When gold flowed to the U.S., foreign nations suffered credit shortages. Factories closed. Trade slowed. And within months, what began as a New York panic had turned into a worldwide depression. Here's the hidden truth. The gold standard wasn't a stabilizing force. It was a weapon. A mechanism that allowed a handful of central bankers to dictate global liquidity. By adjusting rates and controlling gold flows, they could expand or contract entire economies without ever firing a shot. Look closer at the pattern. In the 1,920 seconds, easy credit inflated a bubble. In 1929, tightening credit burst it. And when the dust settled, who still had power? The same institutions that had set the rules: the Federal Reserve, the major New York banks, and the financiers who had access to capital even in crisis. This is the dark genius of monetary control. Crises don't destroy the system, they reset it. Debt is erased, assets change hands, and influence consolidates. By 1932, the Dow Jones had fallen to 41.22, a staggering 89% drop from its peak. But by then, the ownership of America's assets had quietly shifted. Factories, railroads, and companies were bought for pennies by those who still had access to liquidity, the bankers who had caused the contraction in the first place. The mechanism worked perfectly. The public lost their savings. The system's architects gained control. And if this sounds familiar, it should. Because this same pattern would resurface decades later in 1971 when the U.S. abandoned gold entirely, and in 2008 when global banks were too big to fail. Different century, same principle. Credit, contraction, consolidation. The names change. The suits change, but the mechanism endures invisible, unaccountable, and almost divine in its reach. Because the real power in modern civilization doesn't belong to presidents or parliaments. It belongs to those who decide the price of money itself. And what began in 1929 didn't end in 1932. The collapse became the foundation for a new order, one that still shapes our world today. To see how far that power reached, we have to look at what came next. The rebuilding, the rewriting, and the haunting legacy that never died. When the dust settled over Wall Street, America was unrecognizable. The crash had wiped out more than fortunes, it had destroyed faith. But in the ruins, a new power structure emerged. Quiet, calculated, permanent. By 1930, the panic appeared to fade. Factories reopened. Politicians promised recovery. But beneath the surface, the damage was irreversible. The same credit system that had fueled the boom was now strangling the economy. Banks failed by the hundreds. Ordinary citizens lost their savings overnight. And the very institution meant to protect them, the Federal Reserve, tightened its grip even further. It's here that the real transformation began. The 1929 crash didn't just mark the end of an era of speculation. It marked the birth of modern financial control. The Great Depression that followed wasn't just an economic tragedy. It was a restructuring. By 1933, President Franklin D. Roosevelt took the U.S. off the domestic gold standard. Private ownership of gold was banned. Citizens were forced to surrender it to the government at $20.67 per ounce. Months later, the official price was raised to $35 per ounce. Overnight, the state had revalued its own reserves, profiting massively while the public's gold was confiscated. Who benefited? The same alliance of bankers and policymakers who had guided the system into collapse and now rebuilt it under new rules. What began as a financial panic became a consolidation of control. The United States had learned that money itself could be managed, not just minted. In 1963, economists Milton Friedman and Anna Schwartz published A Monetary History of the United States. Their data showed that the Federal Reserve's mismanagement of money supply had deepened and prolonged the Depression. But what few noticed was something deeper in their conclusion. The admission that monetary policy, wielded by a small group of unelected officials, could shape the destiny of entire nations. And they weren't wrong. Decades later, in 2008, the same story replayed. Cheap credit, a speculative boom. Then the crash, followed by bailouts and rescues, designed not to save the public, but to preserve the architecture of power. History doesn't repeat. It compounds.